All right, why don't we go ahead and get started? So thank you guys very much for joining. So my name is Mark LaMonica. Oh dear. You got it? Okay. Sorry, we're trying to figure out how to do this again with Will in the room. But anyway, my name is Mark LaMonica. I'm the product manager for Morningstar Premium, morningstar.com.au, and today we're going to talk about interest rates. First, a couple housekeeping items. So anything you hear today is, starting to get a couple of questions already. Anything you hear today is general advice. I don't know anything about you, so it means I can't offer any personal advice. If you are over in New Zealand, you can go onto our website, morningstar.com.au, and get our FAP statement. And also the New Zealand regulatory authorities would like you to talk to a financial advisor if you would like personal advice. All right, so let's get started today. Oh, but we would like questions, of course. So if you have any questions, please send them through. For those who have joined before, I gave myself a COVID haircut yesterday, which is kind of exciting. Not really. But hopefully when it's time for the next one, we'll be out of lockdown. But we'll see. Anyway, how do interest rates impact asset values? All right, so why are we talking about interest rates? Well, we're talking about interest rates for a couple reasons. So number one, interest rates are at a 4,000-year low, and they've bounced up a little bit, but still 4,000-year low, and that's according to Sidney Homer's A History of Interest Rates. So 4,000 years is a long time. So yeah, it's a good reason to talk about them. And the other reason we're talking about them is because interest rates are critical prices that measure investment risk and set the present value of estimated future cash flows. So we're going to talk about that today and how that impacts the value of all different assets. But first, brief recap of some stuff that's been going on with interest rates. We'll talk a little bit about the history of interest rates, but we had a couple recent pieces of news that came out. So as people that are paying attention to this may be aware, inflation has started to come back. As you can see there in June, the Fed in the US raised their expectation of inflation to 3.4%. They keep saying that they believe it will be transitory, which means that this is just a short-term emergence from COVID restrictions, uptick in interest rates. We'll see what happens. Of course, inflation. Of course, inflation is very important because that could trigger interest rate movements, which we'll talk about. And yeah, this inflation that has occurred has been the biggest increase in consumer prices in 13 years. Now, what has happened? What is this causing and other things in the market causing? Well, a couple things. Number one, when interest rates were cut significantly and central banks around the world started open market activities, which we'll get into what that is, around COVID, try to make sure economies could get through COVID. They came out and basically said, the Federal Reserve came out, the RBA came out, many other central banks, and said that it would be years until interest rates would go up again. So 2024 is what they told us. Well, recently in the Fed, they've started backing off that and bringing that a little closer, said potentially 2023. Now that's still obviously very far out in the future, but things are creeping back towards interest rates going up again. In July, the Reserve Bank, so this month, the Reserve Bank governor came out and still said that in Australia, he thought it was most likely that we would wait till 2024 for interest rates to go back up. He thinks Australia is obviously lagging behind other developed countries in terms of interest rate rises. Obviously, we're not going in the opposite direction of every other developed country in terms of COVID restrictions. But yeah, something to think about. And we'll talk about differentials of interest rates between different countries and how that can impact us. And then finally, and we'll talk about what these open market activities are. The RBA is going to start cutting the amount of government bonds that they're buying every week. And that, of course, has an impact on interest rates. So a lot of stuff is going on here. I think with some of the inflation numbers that we're seeing, I think it's safe to say that we are in a period where the uncertainty about inflation and interest rate levels has increased. And yeah, that's going to impact us all as investors. All right, a brief history of interest rates. So this is the Aussie cash rate. So let's talk a little bit about the Aussie cash rate. So as you can see on the chart, it has come down significantly and has continued to come down off of this chart. So very simply, what is the cash rate? The cash rate is the amount that is charged for overnight loans between banks. So this is really the rate that the Reserve Bank in Australia sets. And this is how they control interest rates. And that's what monetary policy is at the end of the day. It's setting this overnight interest rate mark. So you can see it's gone down significantly. We kind of look globally. Really, interest rates hit their highs kind of around the mid-80s. So in the 70s, inflation was higher. When Reagan came into power in the US, inflation was still running pretty high. And basically, central banks in the US, Federal Reserve, and around the world raised interest rates to try to get inflation under control. That did bring about some economic pains, but basically since then, interest rates have fallen. There's obviously been some ups and downs during that time. It's not gone straight down, but if you really look at long-term interest rates, since kind of the mid-80s, they have come down. And that has had a huge impact on all of us as investors and asset values, which is what we're going to talk about today. So values of stocks, values of bonds, values of real estate, all very dependent upon interest rates. So we're going to talk about that, and then we'll talk about a little bit about what is going to happen if interest rates continue or potentially start going up. So perhaps during the next 30-year period, we may be in a different situation than we were. But this is the Australian cash rate. So central banks traditionally control monetary policy by controlling these short-term interest rates. Well, something interesting happened during the GFC. During the GFC, central banks pumped more money into the system. They started buying, originally, longer-term government bonds. And the idea there was, of course, to not just control short-term interest rates, which, while they do have an impact on all different maturities of interest rates, they wanted to start controlling longer-term interest rates as well. So they bought a bunch of bonds, and that's what we're talking about, is pushing money into the system. So buying bonds keeps interest rates low. That is how central banks work. They inflate their balance sheet by buying bonds, and they started doing that with non-short-term bonds. So that's what you always hear about, quantitative easing. That is quantitative easing. So that happened during the GFC, and even though they started bringing back those purchases and talked about and started to actually sell off assets on their balance sheet, then of course COVID hit, and there was this giant, once again, monetary intervention in the market, and started buying things other than just government bonds, started buying corporate debt. So there was a fear that a lot of companies would go out of business because, of course, there were at least short-term, that's now lasted a year and a half, short-term impacts to the revenue they took in, and they were worried companies were not going to be able to roll over to debt. So all of a sudden, central banks started buying corporate debt. And what you'll see on this next slide is the U.S. Federal Reserve balance sheet. So basically, you can see these two periods. Right here, this is the GFC. So this is when, and during this period, they also bought mortgage-backed securities to try to keep interest rates low on housing in the U.S. But you see, this sort of kept continuing. Then we had this giant spike right here around COVID. So this is like any other bank. A central bank has a balance sheet. They hold securities on that balance sheet. So when they inject money into the economy, they are buying bonds and holding those bonds on their balance sheet. So this is the impact we're seeing here. Now, and just so people are aware, where does a central bank get the money to buy bonds? Well, they're a central bank, so they just create money. So, I think, well, I won't make any comments about that, but yeah, basically you can think about a central bank has a blank checkbook. So they can go out there and buy as much as they want, and that just creates new money and just injects more money into the economy. And that's the way they do it. So when you hear people talking about central banks pumping money into the economy, that's what they're actually doing. They're going out there and growing their balance sheet and buying bonds. So when we go back and look at that original RBA statement, when they said they were dialing back their monthly bond purchases from $5 billion to $4 billion, what that means is they're going to put less money into the economy on a weekly basis. They're going to put less money into the economy on a weekly basis. Now, they're still adding some in. They did not say they were going to zero. They did not say that they were actually going to sell off any of their securities. That has not happened yet. You can see in this period right here, that's when the Federal Reserve Federal Reserve started selling off bonds. And for people that are following the markets, that was the quote unquote taper tantrum, where the market did not react well to the fact that they were actually going to start reducing their balance sheet. But then COVID happened, and now we are once again well above a record high. All right, so let's keep going. So now we're going to talk about what the impact is of interest rates to different assets. So why don't we start with bonds? Okay, so we've got a couple questions about the RBA. So from David and Lisa. So we'll talk about it. Okay, so and they're both asking the same question. So David's asking the bonds that the RBA buy, who issues them? Well, the government issues them. So interestingly enough, and Lisa's kind of asking a similar question, is buying government bonds the same as a company buying its own asset? Yeah, in a way, right? So, central banks are supposed to be independent and are independent. But yeah, basically what they're doing is they're going out there and buying government bonds. So the vast majority, if we take the RBA or we take the Federal Reserve in the US, the vast majority of these bonds that they're buying are US government bonds. So they are buying debt issued by the government. Same thing with the RBA. So the RBA is buying debt issued by the government. And so basically they own the bonds. The government is now paying interest and will eventually pay the bonds back to the central bank. So yes, this is why there's a lot of conspiracy theorists about stuff that's going on with central banks, because I understand, like on the surface, how this does seem, this does seem somewhat shady. That we've got one branch of the government issuing bonds, and then you've got the central bank going in there and buying them. But yeah, the idea is, of course, to keep interest rates low. Now, during two periods in the Federal Reserve, for example, they were buying non-government bonds, which was something very different, right? So during the GFC, they were buying mortgage-backed securities. So those are securitized mortgages. Making this up, but 100 people go out there and buy houses. Those mortgages get sold by the issuer, the bank, to a company that securitizes them. So think all the stuff we heard about in The Big Short. Those are, of course, mortgages that did not get paid back, but conforming mortgages that meet certain standards are issued, sold off, securitized, and sold to investors. So the Federal Reserve was buying them there to keep U.S. Interest rates low on housing so that they could support the housing market. And then during COVID, they started buying government bonds. They started buying corporate bonds. So there are different types of bonds. But yeah, that's what they're doing. So hopefully that answered your guys' question, David and Lisa. Lisa sent me lots of pictures, 2 pictures, not lots, of her alpacas last night. Okay, let's talk about interest rates. One of Nino, which was professionally done photos. Very good. Let's talk about interest rates and how they impact bond pricing, because that's the whole point of this today. All right, so let's walk through a bond example and how they work. All right, so we've got two different bonds here. And bonds, of course, move, and this is what we're going to try to explain. The price of a bond moves inversely to interest rates. So if interest rates go down, bond prices go up. So if we think about what's happened since the mid-'80s until now, bonds have done incredibly well. They're supposed to be boring, but they have done incredibly well because interest rates have continued to fall. And we're going to talk about why, so you can understand why that happens. Now, the issue, of course, we're in is that if bond yield or if interest rates go up, bond prices move inversely, they will go down. So we'll talk about how that could impact you as an investor, but let's walk through why this happens. All right, so let's say we've got example number 1, and let's make this very simple. So let's say Telstra is issuing a bond. So Telstra wants to, of course, bonds are issued, they're loans to investors. So Telstra needs to raise some money, they've issued a bond. So they're issuing that bond of a face value of $100. Okay, so that basically means that is what you are going to get paid back. As a bondholder, you of course get interest, and then you get your money back at the end of the term. They issue it at a face value of $100, you're going to get $100 back. Coupon payment, that is what they're going to pay you over the life of the bond. Now, in this case, we're in a 3% interest rate environment, and they are issuing these. Now, there's a lot of stuff around interest rates that we can talk about, but simplistically, 3%. Coupon payments, $3. So that means every year, for the life of this bond, they will pay you $3. The yield of this bond is 3%. Now, they are issuing this at face value in a 3% interest rate environment with a $3 coupon. That means the yield's 3%, right? You're making 3% a year on that bond. So you're getting $3, it's $100. Maturity's in 5 years, that's when you get your money back, and the price is $100. So you can issue bonds at different face values and screw around the price. You can do all sorts of different things if you want, but we're doing a very simple example. All right, so that's great. All of a sudden, you bought this bond, and you're sitting there, and interest rates go down 1%. And they go down to 2%. So let's say this is a year later. They're down at 2%. Telstra wants some more money. So they want to issue another bond. Well, in this case, it's good news for Telstra, right? They issue the same bond. They only have to pay $2 a year. So they're only paying 2% on this money because those are prevailing interest rates. So great. They issue another bond. That bond goes out there. The problem, of course, is that you want to sell your bond now. So it's a year later, you want to get your money back. You can't wait till the bond matures. You want to get your money back, so you're going to try to sell it. Now, nobody is going to pay you $100 for this bond, right? So you just be silly to sell this for $100. I mean, people pay you that, sorry. You would be silly to sell this bond for $100. And the reason you would be is because you're getting $3 a year on this $100. And everyone else that's buying a new bond is getting $2. So why would you actually sell that? You wouldn't. You would charge more. So what actually happens here? Well, all of a sudden, you've got a $100 bond. You've got a $3 coupon payment. Everything else is yielding 2%. So how do we adjust the yield, right? The yield is just dividing that coupon payment by the face value. We adjust that yield by changing the price. The price goes up. Now, the price is not quite as simple. It's a yield to maturity calculation you have to do. But conceptually, hopefully this makes sense. In this case, because interest rates have fallen, and because you have a bond that's paying a higher coupon amount on a $100 face value, that bond is worth more. Because every other bond you can go out there and buy right away, the newly issued bonds are only paying $2 on a $100 face value. So hopefully that explains why bond prices move inversely to interest rates. The same thing would happen if interest rates went up. All of a sudden, nobody's going to pay you $100 for this bond because interest rates are now 4%. So you're going to have to discount that price so that the yield, what's yielding off the coupon, is actually equal. So hopefully that made sense, but that is what happens with interest rates. Now, a question we often get is, if I'm not going to sell my bond, why do I care? Is that going to impact me at all? And technically, no. So if you want to hold this bond to maturity, then none of this really matters. Interest rates move around. You're investing in a bond, you want that income every year, and you want to get $100 back at the end, so you don't really care about interest rates if you go out there and buy a single bond. And yeah, maybe that's true, but the problem is that almost none of us go out and buy a single bond. So we generally invest, and bonds are difficult to purchase, single bonds. So people that invest in bonds oftentimes will invest through a fund or an ETF. So we want to explore what happens there. And in those cases, you very much care what happens with interest rates. All right, I've got another. Okay, let's move on. Let's talk about what happens if you're buying a fund or ETF. So we're going to use ETFs as an example. And we've got two different ETFs that we're going to look at. And we're going to talk about interest rate risk when we're investors in fixed interest in ETFs. All right, so the first one we are going to look at is we're going to look at this Vanguard Australian Fixed Interest ETF. So this just follows an index of Australian bonds. So pretty simple. And it follows the Bloomberg Aus Bond Composite. Okay, so what happens if you actually own this ETF? How are interest rates going to impact you? Well, now we need to talk about something called duration. So duration is a measure of the interest rate risk on a bond, or in this case, an index, ETF, fund, whatever we want to call it. So we're going to talk a little bit about duration. So what is duration? So basically duration is a measurement of the interest rate risk on a bond. And it takes a bunch of different features into account. So it's going to look at the interest rate, could drive it, when the maturity is, the coupon you're getting paid, any sort of call features in the bond, meaning when can the issuer call this back. So there's all these different factors, but the duration measures the interest rate risk. And using the duration to calculate that interest rate risk, or using that to measure that interest rate is actually pretty easy, as long as you know what you're looking for. So I went to Vanguard's website, and I pulled, obviously, these two screenshots for this bond ETF. And you can see right here, effective duration. Now, duration, so 3.68, duration is generally measured in years. So a lot of people will say, I think perhaps the next website I'm going to show says that, they'll say effective duration 3.68 years. Okay, so don't be thrown off by the years. Basically, all you do with duration is you multiply it by the interest rate change, and that will give you the amount that a bond will change in price. You just have to remember the rule that bonds always move inversely to interest rates. Okay, so how does that work? So right here, let's say interest rates moved 1%. What would happen to this ETF? What should happen to this ETF? Well, if they go up 1%, remember, bond prices go down. So prices go down when interest rates go up. They go up 1%. This ETF will go down 3.68%, according to the duration. So it's an easy way for you to go as an investor and measure the interest rate risk in a certain ETF. Now, remember, there's all sorts of other things that can affect bond prices. So this is all things being equal. The duration will tell you how much the price will change. The other things that, of course, can impact bond pricing is credit risk is the biggest one. Credit risk is somebody going to pay you back? And what is the market's assessment of whether they're going to pay you back or not? So if the market feels like if their credit risk has increased, that maybe the chances of them not paying you back are more, that interest rate's going to go up. And you're going to see changes in the bond prices. Basically, the bond prices will go down. If they think they're more credit worthy, then the opposite will happen. But if we're taking everything else in a vacuum, we can use that effective duration to see what the interest rate risk is of any of our bond investments. All right, so I've got another example on here. Where'd I go? Did I delete a slide? All right, well, I used to have another slide in here that was just showing you, okay, I'm an idiot, which is not surprising. They're not two slides, they're both on the same slides. All right, sorry, this is Vanguard. So Vanguard, effective duration, 6.1 years. This is where it's measured in years. So that means, once again, interest rates change by 1%. The opposite, we expect this to go up or down by 6.1%. And here's a BlackRock. So this is an iShares one. That's their duration. So all I'm showing you is that if you go find any ETF, go to any of their websites, and you can find their duration. You can see their interest rate risk. Now, what is going to change interest rate risk? What is going to change the duration? The longer the bond has until it matures, the higher the duration is going to be. So if you're worried about interest rates, you would buy short-term bonds. If you're worried about interest rates going up. So that's one factor. The other factor that influences duration is the coupon. So the higher the coupon, higher that you're actually getting, a higher amount that you're getting paid, is also something that increases the duration. So you want short-term, low coupon rate bonds if you want to minimize interest rate risk. Okay, so that's duration. So hopefully everyone got that one. Let's move on to stocks, because everyone loves share prices. All right, mathematically, interest rates and share prices have a very different relationship. So it's not as clean cut as bonds, where it's literally math, and you can figure out what the changes are going to be. But let's talk conceptually about what's happened with interest rates and P/E ratio. So a P/E ratio is the price to earnings ratio. It's how much an investor or investors are willing to pay for a dollar of earnings. So once again, a P/E ratio of 10 means people are willing to pay $10 for every dollar of earnings. So it's a relative valuation technique. It's something we can use to measure the overall valuation of the market. So let's look at a little bit of history. So I did two things. So I went back there, I took every single month. So the first of the month, the P/E ratio and the average monthly 10-year US Treasury yield. So I got all those figures for the first of every month from 1980 on, and then I averaged them out by decades. So I literally just took a straight average of those 120 for each decade readings that I had. All right, so the 80s. Remember I said that interest rates are really high in the 80s. Yeah, so the average monthly US 10-year Treasury yield was 10.6%. And we've seen over time, obviously they've come down. So each decade, we have seen, obviously we don't know what's happening in the 2020s yet because we're very early in it. Each decade you can see the impact of these falling interest rates. Now, what has happened to price to earnings? Well, they've basically just gone up. Now, obviously, there's a little bit of an anomaly in the 2010s, but yeah, they've basically just gone up. So once again, this is taking the average monthly P ratio of the S&P 500 on the first of the month. So just wanted to sort of show this because it's kind of indicative of what's happening. So what's happening? Yields are coming down, interest rates are coming down, and valuation levels, what investors want to pay for earnings, is going up. Now the question, of course, is why? And this is where we're going to get into, well, I'm not going to show the spreadsheet, but for people who tuned in to the How to Value a Share webinar that, I don't remember when we did that. Everything's blurring together like a week and a half. And now Will's not here for these anymore, mostly. So it's just me talking to an empty room. But remember, we used a discounted cash flow model in that webinar. So all we said is the value of an equity is the value of the future cash flows that a company will generate. So right, that should make intuitive sense. If I'm buying a business, it doesn't matter what the business has done before. If I'm buying a business, all that matters is from when I own that business, from this day forward, how do I value that? How much cash is that business going to generate? So when we take a discounted cash flow model to calculate the value of a share, which is what pretty much everyone does, every investor does, we build out a discounted cash flow model where we predict, where we estimate what cash flows that company will generate into the future, and then we discount them back to the present day. And the reason we discount them back is because $1 today is worth more than $1 in the future. So time value of money formula. So we are discounting it back by a figure that is very influenced by interest rates. So generally it's a weighted average cost of capital. That of course is impacted by interest rates. So same thing, that Telstra example where they're issuing bonds at 3% environment and 2% environment. If they can get capital, if a company can get capital for cheaper, which they can in lower interest rate environments, then that weighted average cost of capital falls. So if we think about this mathematically, right, that discount rate, how much that discount rate is, if it's lower, if we're discounting future cash flows by less, those future cash flows are worth more. So that is why across the board for stocks, when interest rates fall, people are willing to pay more for those future cash flows because they're worth more. So hopefully people, you can go back and watch that webinar. But yeah, we played with the spreadsheet and sort of walked through this. Now, the interesting thing that we're going to talk about today, so for all stocks, that is what happens, right? So for all stocks, when you're discounting back those future cash flows, if you're discounting them by less, if interest rates are lower, those future cash flows are worth more, which means the company's worth more. Now, there is a difference in how this impacts different types of companies. And we've got two examples here, a high growth company and a lower growth company. So what I did is I went into this very simplified model that we used, and I played around with some of the numbers in it. So what I did is for this high growth company, for the 10 years, so this is a two-stage model we created, for the 10 years, next 10 years in that model, we put in 15% growth. So basically, revenue is growing 15%, means cash flows and everything else is equal. The conversion of that revenue to cash is all equal. So let's just say cash flows are growing 15% a year, 10 years in the future. Then after that, they grow 5% a year. So that two-stage model. So the lower growth company, they grew 5%, only 5% over that 10 years, and then they grow 2% in that second stage, the terminal growth. So what happens if there's a 1% increase in the weighted average cost of capital? Well, you can see this high growth company fell more from a valuation standpoint than this lower growth company. Now, the reason that happens, once again, if you sort of picture the math behind this, the reason that happens is if there's a high growth company, a lot of the future value of that company is off further out into the future because it's growing faster. So those future cash flows are worth more. Or if you're a low growth company, not all of the or a lot of the value is kind of in the recent or in the near future instead of way out in the future. So if we're discounting those cash flows, there's going to have a bigger impact on that high growth company. So kind of think about that. If you think about that and think about how math works, you'll understand why this is happening. So what does this mean, and how have we actually seen this in the market? Well, if everybody remembers back to February, in February when sort of we first kind of got whiffs of inflation, there was this, rather large increase in interest rates in February. Now, this, of course, was just markets increasing interest rates. And what happened after 4 or 5 days of this, central banks intervened and sort of beat these interest rates back down by, you guessed it, massive bond purchases, kind of keep those interest rates low. But over that period, if you go back and look at sort of any equity charts or any interest rate chart, you can sort of see this, that interest rates went up, equity prices went down. So the market had a bad week. I mean, it was only a week or something like that. But what happened was the companies that were hit hardest were these very high growth companies, all of these tech companies, if we want to just characterize them as that. I mean, it's an easy way to do it. A lot of these tech companies that have done so well did really, really poorly. So you had this big fall. What did okay? Banks and financials, which we'll get into in a second. But just something to think about. What is going to happen? What companies are going to get impacted the most? If interest rates start going up, well, it's going to be a lot of these high growth companies where the value of the company is far out into the future. So something to think about. And what has actually done really, really well? Tech companies, of course, right? If we look at everything that's happened since the GFC, once all that money was pushed into the system, if we go back here, so this period right now, what has done really well since the GFC? Tech companies. So sort of since we got out of the GFC, they've been the best performing companies. They've done really well. Why? Because interest rates were going down and all this money was getting pumped into the system to keep those rates down. So they've done very, very well. That sort of short February period, and as the market started to worry more about inflation, they haven't done as well. So just something to think about, that not all stocks are impacted in the same way. All right, we're going to keep moving. Okay, so let's talk about what we should think about as investors. Okay, a couple different things we should think about. The impact of rising interest rates or falling interest rates, no matter what happens, are going to be different on different sectors. So I just sort of explained what happened from a tech company valuation perspective. But the other thing we need to look at is how do the underlying companies perform and the sectors and industries perform in different interest rate environments. Because after all, what are you buying? You are buying a company. So the way that that company performs is obviously pretty important. All right, so I have a couple examples of how this can perform differently. Let's look at financials. Okay, so we're talking about banking companies and investment managers and insurance companies. In general, they all do pretty well in rising interest rate environments. And there's a couple different reasons for this. Let's take a bank, for example. So what does a bank do? Well, a bank lends out a lot of money to people. And one thing that's important is that people need to pay back the money. So generally, when interest rates are going up, we are in times of high economic growth. If the economy is doing really well, then people are more likely to pay back their loans because they're doing well. People and companies and everything else are doing well. So that works very well for banks. So those non-performing assets that banks write off, basically meaning someone has not paid them off, which is just a loss, paid them back, not paid them off, paid them back. Those non-performing assets generally go lower because the economy is doing well most of the time when interest rates go up. The other thing is they earn more money in the spread of how a bank makes money, right? So that is, what does a bank pay you to lend the money to to sit there and open a bank account, for example. What do they pay you in interest versus what can they actually charge out for loans? So generally that spread increases and they can earn more returns on all the reserves that they have to keep. So banks have to keep a lot of reserves to protect them from bad loans. They can earn more money on those reserves in higher interest rate environments. So generally banks do okay. If we go over and we start talking about infrastructure or real estate, so this we're talking about listed real estate. So a real estate investment trust, for example, that owns a bunch of office buildings. Infrastructure and real estate, generally when interest rates are going down, it's a very good time to be in that business because, of course, they take on a lot of debt when they build a new building or infrastructure, build a new road if you're transurban. They're taking on a lot of debt to do that. So, of course, if interest rates start going up, not generally great for them. Now, the other side of that you need to consider is, of course, if the economy is doing well, that can be good, right? If you own commercial real estate, you own a bunch of buildings like this, which is empty right now, then that can be good because your occupancy rates can go up because there's more businesses expanding, getting more real estate. So it is a trade-off. All of this stuff is trade-offs. But generally, they have a lot of debt. And depending upon how that debt is structured, and that's where we'll get into the different one, to this next bullet point, depending upon how that debt is structured, it can have some impacts. So yes, companies in general that have a lot of debt, rising interest rate environments are not great for them. So one of two things can happen. Number one, if they have floating rate debt, so debt that changes based on interest rates, they're going to pay more in interest expenses. But if they just have a lot of debt that they're sort of continually rolling over, so their bond is about to be due, they have to pay the person back, but they just issue another bond to pay them back. Well, they're going to be issuing those bonds at higher interest rates. So that's not great. So look at companies' debt loads. Conversely, if interest rates keep falling, it's a good time to issue more debt. So look at the debt load and look at the maturity schedule and look at, and you can see all of this in the financial statements, if it's floating rate debt or if it's fixed rate debt. So you're more protected, obviously, with fixed rate debt. But consider companies' debt loads and how that will perform. Exchange rates. So exchange rates are really, really important. So especially as an Australian investor who's investing overseas. So one big thing about exchange rates and one big driver of exchange rates are interest rate differentials between countries. So what that means is that if we go back to that first slide where we listened to the RBA and the RBA came out and said, hey, in Australia, it's probably less likely that we're going to raise interest rates early, that we're probably going to raise them in 2024, even if the Fed does in 2023. Think about what that's going to do. So countries that have higher interest rates attract money. So basically that currency goes up. So in that scenario, everything else being equal, where the Federal Reserve in the US started raising interest rates and the RBA didn't, and there was a differential. So basically, the US is paying more for debt than Australia. It's going to attract money. The Aussie dollar is going to go down, and the US dollar is going to go up. All things being equal. There are a lot of other things that can impact that as well. So what does that mean if I'm an Australian investor that's investing overseas? That's good. So if you're investing overseas, you want the Aussie dollar to get weaker. And we've done these webinars before on international investing, but just remember that rule. Same rule as how bond prices move inversely to interest rates. So if you're investing overseas, whatever currency you're investing in, if you're investing in Japan, you want the Aussie dollar to get weaker against the yen because that adds to your returns. So something to think about there. Finally, impact on mergers and acquisitions. So all these private equity deals and everything else that's happening, how do they fund that? They fund a lot of it with debt. So we could see a slowdown if interest rates go up and go up meaningfully. We could see a slowdown in mergers and acquisition activity. Now, why do you care as a shareholder? Well, you care because, of course, this is going to increase valuations. We've seen all this stuff, right? We just saw a bid for Sydney Airport a couple weeks ago, right? So that is an example of somebody going in trying to buy Sydney Airport. If you are a shareholder, In theory, that's a good thing, right? And it did. The price leapt in Sydney Airport because now everyone thinks, okay, well, somebody's willing to pay that much. And even though Sydney Airport rejected that bid and said it was not high enough, all of a sudden it makes us rethink what Sydney Airport is worth. So there could be an impact on M&A activity, which could have an impact on equity prices. The other thing that I guess I didn't put down here, just because I'm an idiot, is substitution effect. So one of the reasons, again, why we've seen valuation levels increase in equities is there's been more demand. This makes sense, right? Because if I'm out there right now trying to invest in fixed interest, there's not a lot of good opportunities. It's pretty obvious you're not going to make a lot of money. You're going to get very, very low coupon rates. So you're not going to get paid a lot of interest. You're also should be pretty worried, or very least, even if interest rates don't go up, what are the chances they're going to keep going down to push up your fixed interest price? People naturally gravitate further out on the risk spectrum and buy equities. So that's something to think about. But then the most important thing, and what we try to say in every one of these and every podcast we do and everything else, is this is all about you, right? It's not about the investment. It's about the investor. So what is the impact on your own finances and spending? It's obviously very, very personal, but think about debt you may have. Is debt you have, whether it's mortgage debt or any other debt you have, is that something that is floating rate? So would a rising interest rate environment impact you negatively in that way? Where do you all of those factors, like in terms of exchange rates, where do you spend a lot of your money? I know we can't obviously leave the country right now, but if you travel a lot and spend a lot of money overseas when you're traveling, that's going to have an impact, a weaker Australian dollar. So for all these things, think about how they could impact your investments, but more importantly, think about how they actually impact you and your own spending. And everything should obviously be about you. Okay, thank you guys. Maybe my hair will grow a little bit by then. But yeah, shoot through any questions, and thanks for joining.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.